Most people think investing is complicated. They picture traders on Wall Street shouting into phones, picking the right stocks at the right moment. Here is the uncomfortable truth. Professional fund managers, people who do this full-time with teams of analysts and decades of experience, fail to beat a simple index fund about 90% of the time. Not occasionally, consistently, year after year. And yet millions of beginners skip index funds for beginners entirely and jump straight into picking individual stocks, losing money they did not have to lose. By the end of this video, you will know exactly what an index fund is, why it quietly outperforms almost everything else over the long run, and how to buy your very first one today, even if you only have $100. Let's start at the beginning. An index in finance is just a list. The S&P 500, for example, is a list of 500 of the largest companies in the United States. Think Apple, Microsoft, Amazon, and 497 others. That list tracks how those 500 companies are doing as a group. An index fund is a type of investment that simply tries to match that list. It buys a tiny piece of every company in the index in the same proportions. So when you put money into an S&P 500 index fund, you are instantly, automatically, a part owner of 500 different companies at once. You are not betting on one company doing well. You are betting on the American economy doing well over time. That is a very different and historically much safer safe bet. This is the question everyone asks. Why own 500 companies when you could just own the best one? Here is the problem. Nobody reliably knows which one is the best one. Not in advance. A company that looks unstoppable today can collapse tomorrow. Remember Enron, Blockbuster, Lehman Brothers? Each one seemed like a solid bet to millions of investors right up until it wasn't. The data on this is brutal. A landmark study called the SPIVA report tracks how actively managed funds run by professional stock pickers, perform against their benchmark index each year. Over any 15-year period, roughly 90% of those professional funds underperform a plain index fund. Not because the managers are bad at their jobs, because markets are efficient. Information is priced in fast. Beating the market consistently is genuinely hard, even for experts. And if the pros can't do it, the odds for a beginner picking stocks on a phone app are even longer. Here is a number most beginners never think about: the expense ratio. That is the annual fee a fund charges you to manage your money. It is expressed as a percentage. An actively managed mutual fund, one where a team of humans picks the stocks, might charge you 0.75% to 1% per year, or even more. A broad index fund at Vanguard, Fidelity, or Schwab often charges somewhere between 0.03% and 0.20% per year. That gap sounds tiny. It is not. Let's put real numbers on it. Say you invest $10,000. Over 30 years, assuming that historical average growth of around 10% per year for the S&P 500, a 1% fee quietly drains roughly $19,000 from your final balance compared to a fund charging 0.03%. $19,000 gone. Not because of bad performance, but because of fees you barely noticed. Index funds win partly because they do less. No research teams, no trading in and out constantly. Less activity means lower costs. Lower costs mean more of the return stays in your pocket. Okay, you are convinced. Now let's make it practical. You need two things: a brokerage account and a fund to put inside it. A brokerage account is just an account you open with a financial company that lets you buy and sell investments. The three most beginner-friendly options in the US are Fidelity, Vanguard, and Charles Schwab. All three are reputable, well-established, and offer index funds with very low fees. Opening an account is free and takes about 10 minutes online. Now, inside that brokerage account, you have choices about what type of account to open. If your employer offers a 401k, a tax-advantaged retirement account, that is often the best place to start, especially if your employer matches your contributions. A match is essentially free money added to your account just for participating. Never leave that on the table. If you do not have a 401k or you want to invest beyond it, consider a Roth IRA. A Roth IRA is an individual retirement account where you invest money you have already paid taxes on. Then it grows tax-free and you pay zero taxes when you take it out in retirement. For most beginners, that tax-free growth over decades is incredibly powerful. For 2025, you can contribute up to $7,000 per year to a Roth IRA if you are under 50. Once your account is open, which fund do you actually choose? Keep this simple. You do not need to overthink it. A total U.S. market index fund or an S&P 500 index fund is an excellent starting point for most beginners. At Fidelity, you will find options like their zero-fee index funds. At Vanguard, you will find their well-known S&P 500 fund. At Schwab, similar options exist. Look for the expense ratio and find the one closest to zero. Another great option, especially inside a retirement account, is a target date fund. A target date fund is a single fund that automatically holds a mix of stocks and bonds and gradually becomes more conservative as you get closer to a specific retirement year. If you plan to retire around 2055, you pick the 2055 fund. It rebalances itself automatically. For a complete beginner who wants to set it and forget it, a target date fund is genuinely hard to beat. The single worst move you can make right now is waiting until you have more money or more knowledge. Start with $100. The habit matters more than the amount. This is the part of the video that should genuinely motivate you. Compound growth, meaning your returns earning their own returns, is the engine that makes index fund investing so powerful over time. And time is the fuel. Here is a concrete illustration. If you invest $300 per month starting at age 25, and your investments grow at roughly 7% per year after inflation, a conservative long-run estimate for a broad stock index, you would have approximately $750,000 by age 65. Start the exact same habit at age 35 instead, and that number drops to around $360,000. Same monthly contribution, 10 fewer years, almost $400,000 less. That gap is entirely explained by time. You cannot go back and start at 25, but the next best day to start is always today. 3 mistakes trip up almost every new investor. First, checking your account every day. Index funds are long-term investments. Markets go up and down constantly. If you watch every dip, you will panic and sell at exactly the wrong time. Check in quarterly at most. Second, trying to time the market, meaning waiting for the perfect moment to invest. Research consistently shows that time in the market beats timing the market. Get in, stay in, and add money regularly, regardless of what the news says. Third, stopping contributions during a downturn. When the market drops, your regular contributions are buying more shares at a lower price. That is actually a good thing. Stopping because things look scary is the opposite of what the math tells you to do. Let's bring this home. An index fund lets you own a tiny piece of hundreds of companies at once, automatically, at a very low cost. Professional stock pickers fail to beat these funds about 90% of the time, so there is no shame in keeping it simple. You open a brokerage account at Fidelity, Vanguard, or Schwab. You choose a low-cost S&P 500 or total market index fund, and you start contributing consistently, even if it is just $100. The fee you pay matters. The time you start matters. The habit of staying invested through market swings matters. Nothing else does, really. Your one action from this video: open a brokerage account this week. Not next month, this week. It takes 10 minutes and you can fund it with whatever you have available. If this breakdown was useful, please give the video a like. It helps Plain Money reach more beginners who need this stuff. Subscribe so you do not miss the next one. And drop a comment below. What has been the biggest thing holding you back from investing so far? I read every reply.